The upcoming Reserve Bank's monetary policy is much awaited for a bunch of reasons. Three big central banks in the world have cut rates and cut rates substantially. The Israeli war is about to escalate and the MPC has three new members. So let's turn to our own experts. CNBC-TV18 Citizens MPC is here for their deliberations. Chairman Pranab Sen and members Sajid Chinoy of JP Morgan, Soumya Kanti Ghosh of State Bank, Samran Chakrabarti of Citibank and Sonal Verma of Nomura. Gentlemen and Sonal, as always, thank you very much for joining in. Sajid, I'm going to start with you because of the global backdrop. The Fed has cut more than expected and so has the Chinese PBOC. Won't this prevail on the MPC? To what extent?
I think the global environment is actually far more nuanced than is believed. One would get the impression that with the US labor market slowing and the Fed announcing a 50 basis point cut, that the US is hurtling into recession. But that's not actually the reality on the ground. If you look at the Atlanta Fed, in their estimate, third quarter in the US, July to September, is actually tracking 3%, very far from any recession. And if you look at the internals, both consumption and capital expenditure are holding up. So, in fact, the US resilience story has gotten more support in recent weeks. Now, despite that, we think the Fed will continue cutting because they have more confidence about inflation. And, the Fed's estimate of its neutral rate is somewhere close to 3%. They're currently, even after cutting, they're at 5%. There's a lot of space for the Fed to cut. So you could still be in this Goldilocks situation where the US is resilient and the Fed is cutting and monetary conditions, not just in the US, but around the world are easing because once the Fed moves, many other central banks move. And when monetary conditions ease that much, you're actually buying insurance for 2025 growth. Now, this is not to minimize the near-term risk of a recession. We still think there's about a 35% chance the US slips into recession this year. But if they don't slip into a recession, the Fed easing and the monetary easing around the world actually argues for higher growth next year.
Can we be that sanguine about the crude angle now that there seems to be an escalation? Sonal, until last week, one could be a little more sanguine about the global situation. But with the war escalating, do you think the Reserve Bank has to pencil in more uncertainty and therefore should not ease too soon?
Latha, I think, if we look back at the last 2.5 years, we have had nothing but uncertainty to deal with. And particularly the geopolitical tensions is something we've had like periodic episodes of escalation. And clearly we are in one right now, which is putting an upward pressure on prices. So in terms of how this plays out and the uncertainty is something that we don't know how it's going to play out. That said, I think if you compare where we are today versus where we were back in August, we were actually above $80 per barrel on oil prices. And today, with this geopolitical risk premia being built in, we are basically somewhere around mid-$70 on oil prices. And specifically for India, the oil marketing companies are actually sitting on a large cushion in terms of margins. So in terms of the pass-through to domestic prices actually should not be there. And RBI in its projections has been working with $85 per barrel on Indian basket of oil. So I think we have more than enough cushion. And I think the other angle to look at is also the impact the uncertainty is going to have on investments and growth going forward. So there's also the demand angle to keep in mind. So I think, yes, there is uncertainty, but I think we have enough cushions.
No, I take your point. I'll, time permitting, come to the geopolitical angle again. But Samiran, first let me tackle domestic inflation. After all, the Reserve Bank reiterates it looks at domestic factors. And here, as Sonal points out, $74 is not hell for us. We've seen worse. And what about food? We saw 2 months of food coming down slightly, though not across the board. Will that still be a good reason for RBI to worry?
At it is that the base effect-led decline in inflation is now behind us. now the base effect will turn adverse. And even if there are no significant uh, new price pressures, we're still going to see three inflation prints which are close to 5%, if not more. So that situation could worsen further if we see that this tail end of the monsoon being much stronger than usual, leading to some increase in vegetable prices, and that feeds into things. The second risk to look out for is what we were discussing from oil prices, though maybe not as much of a risk for India because retail prices are unlikely to be hiked anytime soon. And the third is from the China stimulus. If this persists, if China also goes in for a fiscal stimulus on top of the monetary stimulus, then the commodity price increase at a broader level, particularly with respect to metals and all, and gold, that could feed into the inflation forecast as well. So these are some of the upside risks that we have to look at in the short term. However, we are very conscious that the whatever exclusion-based core inflation measure one looks at, they're all very benign. So it's not that there is a huge inflationary bias for the overall economy. And RBI needs to make a difficult call between actually waiting to see the inflation prints turn to 4 versus taking a call on their forecast, how forward-looking they're going to be to see that 4% being met on a durable basis. I think that's the critical challenge that one needs to look at.
Point taken. And in that critical challenge, growth appears to be pleading for a bit of softness from policy. Shaumya, would you agree that the August-September numbers on so many things, core sector, IIP, PMI, seem to be indicating that the economy is softened in the second quarter. So will growth be a reason for the Reserve Bank to be dovish?
Yeah, thank you, Latha. I think yes, there is evidence of growth slowing down. If we actually look into the leading indicators, more specifically the consumption-facing sectors in terms of two-wheeler sales, in terms of passenger vehicles, in terms of tractor sales, I think they're all showing signs of a slowdown. And particularly, I think August and September months could see some signs of a slowdown, definitely. And also the fact that if you look into the latest bank credit data, that also saw a significant perceptible slowdown. Even in incremental terms, if I adjust for the merger last year, the total incremental credit growth for like-to-like period till the end of August was actually 2 trillion down from last year. And for the first time in the last 2 years, the gap between the credit and deposit growth is now narrowed down to only 220 basis points. And in fact, on a year-to-date basis, the deposit growth rate is running much higher than the credit growth. So yes, there is evidence of credit growth slowing down. The indicators also showing that there could be some soft patch of data which could come through in the next couple of months. So my sense is that it may not be the time to say that growth is going to slow down because we need to see some more evidences. But one point on the table is clear, given the current geopolitical conflict and the talks of an war getting elongated or getting prolonged or getting broad-based, I think what should be also on the table on the Reserve Bank to address the growth concerns to be the financial stability concerns. So I think overall, the Reserve Bank faces a delicate situation, but for the time being, I think it could still ride through with perhaps a message that there should need to be some sort of an hand-holding in terms of growth, even though the evidence is not clear yet in terms of an perceptible slowdown in growth numbers.
Dr. Sen, if you can combine all these points and also the fact that, what Sonal pointed out, despite the fact that there have been rate cuts, despite the fact that, the US GDP growth is 3%, despite the fact of a fairly elevated escalation of tensions, crude is only $74. I mean, we have seen 80, 90 as recently as April. So it looks like the global growth is not so strong, demand not so strong. Is that an interpretation the RBI has to take both domestically and globally, that growth is not so strong?
Well, no, I mean, the RBI will have to take into account for sure. But the point is, how important is it? If you really look at what effect the global economy has had on the Indian economy, which is really the focus of RBI's action, it hasn't made much of a difference. And we've been talking about this for a while now. And all the prognosis that have made don't seem to have been borne out by the developments. So I don't think what is happening globally is going to worry RBI that much. The bigger concern, I think, is what is happening domestically. And there, I think there's a whole bag of mixed signals coming. Shombo just pointed out to a series of data points which tends to indicate a certain degree of softening. But there are other data points which seem to suggest that if nothing else, at least private investment seems to be picking up. Okay. So I suspect the RBI is going to be focusing much more on that. Okay. Right? And that, to my mind, is really the key issue, that there is a huge amount of uncertainty, global uncertainty for sure, but I think there's greater uncertainty on the domestic front. It doesn't seem to, I don't think any one of us can take a judgment call and say it's going up or it's going down. I mean, it's still moving around, which means that one needs to be flexible.
Okay. Not commit yourself to either side. Okay, on that note, I'm going to take a break. But thereafter, I'm going to ask you all to commit yourselves on what stance the RBI would take, on what they would do to rates and when. Those questions in a minute.